everyone. I'm Pamela Hastings, Relationship Manager at Barometer Capital. Joining us as always is David Burrows, our Chief Investment Strategist and President here at Barometer Capital. And on today's webcast, as always, we will provide you with a brief macro overview and of course, be willing and able to address your questions at the tail end of the conversation. So don't be shy. You can email me at phastings@barometercapital.ca or send us a question via the Zoom chat or the Q&A. And with that, on this beautiful almost summer afternoon, David, I turn the conversation over to you. Thank you so much.
Great. Thanks, Pamela. Thanks, everyone, for tuning in this week. We had a lot to talk about last week. It's been a bit of a quiet week this week. So we're going to run through a bunch of slides. We're going to be fairly quick and think about the fact that we're now in the lead up to second quarter earnings. We're into the last 2 weeks of June. It's often a quiet 2 weeks. We are beyond Fed commentary. So not a lot of near-term catalysts, some really good housing data out this morning. So what we're going to do is touch on some of the top-down work that we're doing and just do a quick status check. So just off the top, we continue to think we're in a structural bull market in equities. This is the S&P from the right side of this box on to present, 2013 to present. This is the bear market we've been going through, really that started in January of 2022. We saw a low as we touched the 200-week moving average in October. We've been making higher lows since then. It's always easier to take the lens back and look at it in this way because, frankly, it tells us a bigger picture view than the daily wiggles. So off the top, we're still down about 8% off the highs at the beginning of 2022, and the S&P is certainly showing some healing properties. When we look at it on a nearer term basis, we saw all of the breadth data that we follow flip up in the third week of May. And since then, we came out of this consolidation that we had been in since the March lows, and the market has marched its way higher, to no small part driven by the strength in the NASDAQ 100. Clearly NASDAQ over the course of the year has been driving the majority of the returns. If we X out the returns from the top 6 NASDAQ stocks, S&P, the average stock, is a little over flat, but certainly under the surface, we're seeing some improvement. Now, we hear a lot of commentary about the NASDAQ, a lot of commentary about the S&P. Of course, we're not an S&P 500 mandate. We've got a mandate to be in a bunch of different areas in our home country here in the TSX. Not been so exciting. TSX is up 1.65% for the year. Similar price pattern to the S&P in that we made the low in October, a higher low in December, retested the lows in March, and made higher lows in May. However, not making the same kind of progress, and that has to do with some of the sectoral makeup. I would, though, expect that to start to pick up. We've seen breadth in equity markets around the world improve. We've seen global markets, have a 12-month period where they outperform the U.S. market, led by countries like Japan. This is 2012 through 2023, so 11 years. But look at this last year and a half. It's a significant breakout of the range. This is the Nikkei 225 back to 1991. You can see just how dramatic these last 3 months have been as we look like we've started a new bull market with Japanese stocks. India also having come out of a major multi-year period, Mexico out of a multi-year period, Argentina out of a multi-year period. We've seen the breadth of the advance for equities as an asset class as a whole expand. And given the fact that the Canadian market has tended to have a higher correlation to global markets than the US market, would expect to see it start to participate on a greater basis. So healing is the theme. It's not been a straight up move. There have been lots of zigzags over the last number of months, lots of negative news for the market to absorb. But we think in general, things have been improving. We've talked ad nauseum about the fact that 2020 was likely a generational low for yields, and that what works during falling yields is different than what works during rising yields. We are in a rising yield period after the decline in the 10-year yield starting in 1981, the lows at 0.5% in 2020. We've sure seen a sharp move higher, and we've been in a consolidation of that initial move now for about 8 months, but really not showing any signs of rolling over. This is the TLT. which from the top to the bottom was down 48%. So that's the ETF that owns 20 and 30-year US Treasury bonds. If we just take last year down 32% from the beginning of the year to the end. And despite a mountain of money being put to work in bonds, thinking that yields are attractive where they are, you've got a positive return of about 2.43% on price year to date. Not much progress, and certainly doesn't stack up for what we're seeing in certain parts of the market. The aggregate bond index up about 1.3% on the year, down 15.5%. That's a universe of bonds across maturities and different issuer types, and down a whole bunch from the highs in 2020. So our view is, while in the short run, for short-term bonds, it's a place to get some yield. Once you X out tax and X out inflation, there's not a ton left, and there's not a lot of excess return that you can expect. So it is a safe haven, and lots of money's gone to hide there. But I would say, in general, given the amount of money that's moved into that asset class, really very little return. So stocks relative to bonds continue to be the place. Secular bull market stocks, importantly, spread broadening globally. Commodities have been consolidating now for several months. We're waiting to see if we get a breakout in the broad-based commodity indices, but certainly we've seen strength in things like agriculture having broken out of their range, uranium broken out of their range, and recently this week, natural gas producers threatening to break out of their consolidation range. Remember, we're looking at longer term pictures here, multiple years. And while it feels like a long time over the course of 22 and the beginning of 23, not to be making progress, given the fact that we've seen such a tough Fed stance, it really has done very little to knock down the prices of commodities producers. And as the pressure comes off and the Fed has signaled a pause, been careful to say he could, start raising again, but our guess is they're probably done. This can take the pressure off these interest rate sensitive groups and let them work their way higher. Real estate investment trust, despite again a nice yield, has not been a great place to be. This is relative performance versus the S&P. We're actually today at relative strength new lows for the year versus the S&P 500. So real estate, one of those assets that helped by lower rates, really not showing any relative performance, despite the fact that most REITs, do pay a decent yield. Like this, clearly the view on asset prices in this group is lower. So US dollar continues to be an important linchpin. We made a high in the US dollar in October, a lower high in December. As in each case, the market made higher lows. And of course, we've made lower highs since then, sitting below all of the long-term moving averages, 200-day, 150-day, 50-day moving average, 21-day, 9-day. The theme is that, moving averages are moving lower. US dollar looks like it's working its way lower. And last week, we spent a bunch of time talking about the fact that after 2000, US dollar backed off for almost 10 years versus the basket of world currencies. And what worked during that period of time was global markets, commodities, energy, industrials, the types of things that we've been focused on here over the last little while, which we believe have a really good long-term opportunity coming from very low valuations and are under-owned. So as always, we're always focused on looking at all of the universes that we can focus in and trying to drill down to those that we think have a tailwind, and then find securities that are good getting better within those groups to build our portfolios. And in general, we're just constantly looking for areas that are showing expanding breadth. Where is money getting to put to work? Where is buying spreading to a broader number of securities? And on the other side, being defensive in groups where the strong ones may be doing a little better, but the weaklings under the surface are selling off. That tells us that the ice is getting thinner. So just quickly, middle of May, our breadth indicators for stocks, or the percentage of stocks in uptrends in the US, had been backing off over the course of the previous 30 days. Breadth in Canadian market had been weakening, and our short-term indicators had been deteriorating. As we sit today, it's a different picture. There has been broadening. So despite the fact that the market has been so focused on the very largest of large cap tech stocks, we have seen buying spread. And what's really important is that week by week, we see markets move, month by month, we see markets move. What is healthy is a broadening advance. And we are seeing that. We're seeing broadening advance in the US. We're seeing expanding breadth in global stocks. Under the surface, we're seeing the percent of stocks above the 50-day moving average expanding. In fact, if we looked at the world index in October, only 20% of stocks were trading above their 50-day moving average. Market rallied and pulled back into March, where 28% of stocks were trading at above their 50-day. When the market pulled back in April, we got to a point where 40% of stocks were trading above their 50-day. As we sit today, over 50% of stocks trading above their 50-day moving average. So it means that stocks are getting better over time. In the US, we went from a low point in March of only 18% of companies trading above their 50-day to today, 66% of companies trading on the NYSE above their 50-day moving average. The broader the advance, the more shock absorber there is built into the market, the more evidence it is that a broad number of stocks are in uptrends. And this is really important to us because ultimately we want to be most invested at times when there's a broad-based advance, when there's a big shock absorber in the market, because there is going to be news and we are going to get lulls. The next 2 weeks are a quiet 2 weeks. There's not a lot of news to come in the quiet period leading up to earnings. Today, we're going to get some news from UPS in the transports. We'll watch how the market reacts to that. But the net of it is we want to make sure that we're focusing in areas of expanding breadth. In the middle of May, the average sector had just about 35% of stocks in uptrends. And lots of sectors in small letters here were sectors where breadth was contracting. The picture looks different today. As opposed to 35% of stocks in uptrends in the typical sector, the average sector now is 44% of stocks in uptrends. And you can see almost every sector in capital letters, meaning breadth is expanding across the board. It's a slowly improving market. Now, this doesn't happen all at once. We'd love it too, but this is a process. And as long as we know we are in groups with expanding breadth and the market has an expanding participation group, it's likely that money will continue to flow in despite what commentators might have to say. Now, if it starts to change, we can change our stance, but our job is to understand the message of the market. What's the market telling us? So, of course, technology continues to rally, but I will highlight that hits the 150-day moving average down here at 138 on the XLK ETF. We're sitting at 171. We are very extended above the moving averages, even above the 50-day. And often you can see that markets have a way of pulling back and testing the 50-day. It's not impossible that we could see a pullback in the tech sector, which means we want to see participation from other groups. Industrials, after a long period of consolidation, broke out, and over the last since breadth started to expand, a great move higher back toward 52-week highs, and the equally weighted S&P outperforming the market cap weighted. That's healthy. It means it's a broad-based advance. The XLF, an area of significant weakness through the month of February, has now put in higher lows, and since breadth turned higher, up 7%. And that's more in insurance, a little less in banking, but the group as a whole showing improvement. We just want to see the market continue to heal. A conundrum for those that think the economy is going off a cliff. This morning, new housing starts up sharply, and the housing stocks clearly have been telegraphing that. From the beginning of the year, the home building group is up 35.7%. And we've been highlighting this series of higher lows, looking much stronger than the market. And here we are at highs not seen since the beginning of 2022 or the beginning of the bear market. So we always have to remember that markets discount the future. This slowdown in housing stocks was a concern about the Fed's rising rates and what it might do to consumption. And now we are clearly looking beyond the Fed tightening cycle to the fact that we have a whole bunch of folks starting families later in life, and there's a shortage of homes for sale, especially because of the rising rates and the fact that Americans have, 30-year mortgages. And if you tied up a 30-year mortgage at a really great low rate the last number of years. Do you want to move and lose that mortgage and have to reset with a new one? So really great for the home builders. Transports, since breadth indicators turned higher, up 7.4%. Certainly, again, all of these in the last couple of days pulled back a little bit, but that's not an unusual thing at this time of year. This last 2 weeks of June, we can see a little bit of sloppiness, and most importantly, higher beta stocks or more economically sensitive stocks, since the market started to sense the Fed might pause, are up 15% as a cohort. So look, we try to spread our money around. We try to have diversified portfolios, but we try to focus in areas that where we're seeing positive breadth. About 22% of our firm assets are currently in tech. And that is an underweight relative to the index, but our view is they are extended and they can certainly pull back. We have an overweight in financials because over the course of a cycle, we think the financials are well suited to inflate during a reflationary cycle. Industrials that are significantly outperforming the market are a significant overweight. We have an overweight position in energy, combination of oil and natural gas. We have an underweight in healthcare and the rest of the defensive groups. We think people have been hiding here to avoid a recession, and they've been making no relative returns given that defensive stance. If the market is sniffing out the next cycle, it is unlikely that those are where that's where the money is going to go looking for returns. We have an overweight in materials. We have an overweight, an underweight in consumer discretionary, although that position has been rising. So we continue to be skewed up at the top end of the portfolio and skewed in general to dividend growth. Last couple of points just to touch on. We talked last week about the Canadian dollar and the fact that it started to lift versus the US dollar, continued this week. It's come out of the range it's been in, going back all the way to September of 2022. This is, I think, the first signs of strength that the Canadian market may be attracting some capital. And I want to leave this just for now. It's not impossible that in this last 2 weeks of June, we can get some bumpiness. You can see historically, this is a tough 2 weeks leading into earnings. The important thing is that the backdrop is improving breadth. So it means there's a shock absorber built in. If we get a couple of weeks of sloppiness, there'll be an opportunity to take a little bit more cash and put it to work. And the period following this piece tends to be a stronger period, and we'll look forward to summer rally. Look, if things start to get more difficult, we're very happy to get defensive. But I think it's important for all of our investors to look forward to that 2 or 3 years that comes after a bear market. We're through it. Through the course of 22, our accounts were down significantly less than a balanced portfolio, which had the worst year since 1931. A balanced account in the S&P and the bond index was down 21%. This year, we're looking forward to the upcoming cycle, the next 2 to 3 years, and we can see clearly and empirically that there is improvement going on underneath the surface. So Pamela, if there's any questions, not a lot of micro to talk about today.
Hi, of course. Thanks, Dave. We certainly have some questions here. One from our treasured viewer, Stephen from Toronto. Dave, he's curious about how the pools are participating relative to the global market. He's wondering specifically about income balance, global macro. Are these funds limited to Canada and the US? He just would love your insight on that.
Yeah, so as far as geographic bias, a lot of our clients in the pools are Canadian clients, and we think that likely Canadian dollar, and it looks to be the case, rallies versus US dollar. We showed last week how from 2000 to 2009 US dollar pulled back sharply, and it was over a period of years. But over the first couple of years, the dollar went from about 75 versus the US dollar to just about par. We think that the Canadian dollar can firm. Also, with global stocks starting to perform well, Canadian stocks are likely to follow. We do have some exposure to global in for instance, our equity pool. We do have some exposure to global in our income pool. The majority of the global exposure is in global macro, and close to 40% of that portfolio is global. The mandate does allow us to be, significantly in the US. In the pools, we can hedge back to Canadian dollars, which we do. And so we have a little bit more US exposure in our separately managed accounts. We tend to have a little bit more Canada because we can't hedge currency. So it really comes down to the mandate, and certainly happy to answer those questions kind of one-on-one.
Thanks, David. The next question comes from Lawrence. He wants to know your thoughts on buying puts on the big tech movers.
One of the things that we've learned is it doesn't tend to make sense to bet against a strong trend. So you can get a reversal at any time, but you can get your face ripped off doing it, and the puts can go to zero. So we're not on that program. We have roughly 21% of our equity exposure in large cap tech. That's a big weight for us. But that being said, there is a very strong thematic push for money to continue to work its way into those groups. So it can pull back at any time, but we're not going to bet against the strong relative strength theme.
Thanks so much, Dave. Well, that concludes the questions we've received this afternoon. The weather must be getting pretty nice in Toronto. Your viewership is on par as always, but I feel like people are out there enjoying the weather sooner rather than later.
Well, look, it's likely going to be a kind of a quiet couple of weeks from a market's perspective, but I really think that it's important for us to be looking forwards. So if there's a message that I can deliver, I get it that there are a lot of people who have wanted to be defensive, and we have avoided the defensive sectors largely because they've made very little progress in the perfect conditions for defensive stocks to do well. If the market sniffs a better environment, they're likely to do worse on a relative basis than they already are doing. From a tech perspective, it is definitely working. My view is part of that is investors going back to what they knew worked in the last cycle. Tech is very expensive. It is broadly owned, perhaps over-owned. So it's not the only place to be. Unless we think that we're not going to get beyond the Fed, and unless we think that there is real evidence of a hard landing, we want to be in early cyclical stocks. And early cyclical stocks include the other sectors that we're focused in. And frankly, Canada is an early cyclical market. So, we have to have a balance between what's working right now, what's showing signs of working, and what is likely to participate over the course of a market cycle, and where the good risk reward is, what is under-owned, what is reasonably priced, and what is showing the right signs of a bottoming process. So I think for most Canadians, it's frustrating watching the Canadian market basically flat on the year while the NASDAQ is rolling. I get that. And we certainly are participating in those big NASDAQ stocks. And we're not overly caught in groups that aren't participating. But, when we as Canadians look across the border, what's happening in the US, it gives us some optimism. But frankly, what makes me more optimistic is seeing the expansion in breadth and improvement in global markets, which is going to be more relevant to us longer term. And people forget that the US market can get to a point where after very, very strong performance, it underperforms for as much as a decade. And that's not impossible. And we have to be assessing that as a risk.
Thanks so much, David. That concludes all of the questions we received. Thanks again for a great overview. And we'll see you again next week. Same time, same place.
Great. Thanks, folks.